The Federal Reserve kicking off its two-day meeting today. Now, the big focus is going to be on the central bank's economic projections. Investors are right now looking for any clues on the timing of that first rate cut. Traders right now pricing in about a 55% probability that we will see that first rate cut in June. To break this all down for us and what we could expect from the Fed going forward, we want to bring in Robert Kaplan. He's the former Federal Reserve Bank of Dallas president. Thank you so much for being here.
Good to be here.
So let's talk about what we are likely going to hear or see from the Fed this week. There's been so much emphasis placed on economic projections on the dot plot, how many cuts we are going to get between now and year end. How are you looking at that?
The Fed said in December that they were penciling in 3 for this year. I still think that's a pretty decent estimate. It may slip to 2, but it'll be in the neighborhood of 2 to 3. But the most important thing that I think Jay Powell will try to do coming out of the meeting is keep his options open and keep the Fed's options open, because there's a lot of mixed data and cross currents. And so I don't think he wants to be boxed into any particular month or action, but he wants to leave the options open that if they want to act in June, they can, but also they reserve the right to kick the can a little bit beyond June.
So they've continued to talk about data dependency, and you're giving a nod to the mixed data that we are seeing right now. So where would we see more of a trend be locked in that's in line with what the Fed's targets are?
So I'm much more of a fan of what are the drivers of the data than the actual bouncing ball of the data itself.
Sure.
And the drivers, the 2 or 3 drivers I'll mention. The economy remains resilient. However, and the job market remains very strong. There's been a little bit of increase in labor supply, which is helpful to the Fed, and that's why the unemployment rate ticked up. But the truth is there's still very strong demand for labor, and maybe productivity is improving a little bit. The big cross current that I think the Fed is dealing with, and they may or may not want to acknowledge, is fiscal spending. We ran a 15% deficit as a percentage of GDP in 2020. We ran another close to 15% in 21. That was due to ARPA. But that ARPA money actually is still not been fully spent. And then you've got the Inflation Reduction Act, and then you've got the Infrastructure Act. And so last year we ran a deficit over 7% of GDP. In 2019, the deficit was 4 and a fraction. Here's the point. Fiscal spending, I believe, is one of the big reasons the economy's been this resilient. And it's a big reason why the service sector, inflation in the service sector, is very resilient. We have an aging society. I wish we weren't aging, but we are. And workforce growth is decelerating. And so people are struggling to find workers in the service sector. And I think that makes inflation sticky. And so the Fed, looking at all these cross currents, is trying, they don't want to move prematurely. It's been a long battle in inflation. We're still at full employment. And so I think they're going to be patient, and I think they ought to be patient.
Is that enough then to maybe support the argument out there that maybe in fact inflation has stalled and will stall around these levels for a little bit?
It's possible. Now remember, there's 2 big parts of inflation: goods and services. In the goods area, not perfect, we've got pretty good disinflation in goods. It's the service sector that if there's a stall, and it all revolves around workers. Excess demand for workers, not enough workers. And we're seeing, if we see some stalling or stickiness, it'll be in the service sector. And again, if you're spending on new battery plants throughout the United States, that's the Inflation Reduction Act, new infrastructure projects, the unspent ARPA money from 2021 is still being spent. That increases demand for workers. So there's a lot of sectors in this economy that feel like they're in a recession, anything interest rate sensitive. But this government spending on these projects, in my opinion, is creating a resilient bid for workers, and that may be creating some of the stickiness, which may create some of this stalling that you're referring to. But I don't know, and they don't know. The Fed doesn't know, and so when you don't know, turn over a few more cards and play it out. And if the unemployment rate were spiking, there'd be more urgency to act, but it's not. And so as long as employment stays strong and unemployment stays low, I think they've got the luxury of patience.
The Fed has leaned into, of course, its dual mandate, as it should. We had Fed Chair Powell, though, acknowledge that the pandemic may have changed in a sustained way how they target inflation in recent weeks. And so with that in mind, should the Fed be over-indexing or giving more weight to some data points than others as they're trying to figure out what of the past they can lean on to try and combat the same inflationary pressures?
They should be looking at data, but they should be looking at, again, fundamental drivers that explain the data. Right. Problem with data is it gets revised. It could be incorrect. It could be misleading. It's aggregated.
Which happened with the employment situation where we got those two key revisions.
I think the big fundamental drivers are we've got a decelerating, aging workforce, and we've got substantial government spending that is bidding on workers. Again, the flip is you've got a lot of immigration. Maybe some of those workers are entering the workforce. That would help. Mm-hmm. Productivity may be improving. That would help. I mean, you could grow faster with lower inflation. And so it's not clear, though. And sometimes when it's not clear, you don't want to be a slave to the data, but you want to see some discernible, sustainable trend. And so far, lately, we haven't quite seen that. And I think just take more time, turn over a few more cards.
So what does that then tell us about the soft landing narrative? It seems like that, from the points that you're making, that at least has the highest chance of happening at this point.
I think so. So the good news is, for me, it's unlikely in the near term we're going to have a recession. The bad news is the cost of that soft landing. You've got government debt to GDP over 100%. Mm-hmm. You have government interest expense on its way to $1 trillion by next year. Rates are staying high. That really burdens business, but it really burdens the federal government when you've got $9 trillion of treasuries to sell this year. So the only thing is, everybody's obsessed, understandably, with what the Fed's going to do. The Fed will do its job. I think they should be more obsessed with the government spending and the leverage at the government level and government interest squeezing out government programs. I think that's going to be the bigger issue to deal with. And I think we do well to focus more on that issue. I think that's an issue that's going to be more thorny in the months and years ahead.
There's some overexuberance within the markets right now as it pertains to the sentiment either driven by the AI rally or driven by the level of cuts or the pacing of the cuts that we would get, as well as we saw through the B of A Global Fund Managers Survey, the sentiment the highest since January of 2022. All that considered, for this market, what should they expect of the Fed to either continue to deliver or kind of dampen down some of the expectations?
So my own view, if you look at financial markets more broadly, equity markets, if you've got growth that's sustainable, if you've got improvements in productivity, which is obviously helping, AI as part of that, right, then you could tolerate higher rates because you've got growth with it. I think the fear for the equity markets, for example, and other markets is you got slower growth and still sticky inflation. But right now, I think the stock market's responding reasonably well, not just to the Fed. They'd prefer the Fed would have been able to cut rates by now. But if the reason they're not able to cut is growth is better, then that's bolstered the stock market. My concern is this government spending will eventually need to peter out. Mm-hmm. We're going to need to get it under control. And then I think you'll see a clear picture of what's the organic strength in this economy. I think it may be slower growth than what we're seeing now. And I think that's more of a looming question for the markets.
But should this market brace itself to be upset by the Fed in the near term?
I don't think the Fed itself is going to upset them. I think the Fed will do its job. Listen, 2 years ago, I felt the Fed was dramatically out of position. Rates were too low. They were still buying bonds. It's now done a 180 and fixed that. I think the Fed is well positioned now, will do its job. I don't think the Fed by itself it's going to do what it should do. I think the market actually should be more worried about the fiscal situation and how much of this growth is organic versus artificially stimulated by government spending, which is unlikely to be sustainable. That's a bigger issue. I think not the Fed. Fed will do its job.
Robert Kaplan, former Federal Reserve Bank of Dallas president. Thank you so much for taking the time here with us in studio.
Good to talk with you.